You know, you hear it on the news all the time. The Fed is raising interest rates. But have you ever stopped to think about what really happens next? How does that one decision, made in a boardroom, ripple out and affect a small business on Main Street? Well, a really fascinating paper by Mark Gertler and Simon Gilchrist gives us a powerful answer, and it's all about the hidden story of small manufacturing firms. So let's break it down. Right, so let's start with the central question. When the Federal Reserve decides it's time to cool down the economy, to hit the brakes, it's not like everyone feels the slowdown in the same way at the same time. The impact is uneven. So this paper asks a really important question. Who feels the pain first? And why does it all seem to happen so darn fast? Okay, to really get this, we've got to start with the traditional explanation. Think of the Fed as having this one giant lever it can pull to manage the economy. But how does pulling that one lever send shockwaves through every part of the market?
The textbook answer is pretty simple. When the Fed hikes rates, borrowing money gets more expensive. That's it. So families are less likely to get a mortgage, businesses are less likely to take out loans to build a new factory. The idea is that everyone just kind of tightens their belts a little, spending slows down, and the economy cools off nice and gradually. But that isn't really the whole story.
Yeah, because if that simple story were all there was to it, you'd expect a really slow, gentle cool down. But that's not what happens, is it? Sometimes it feels like the economy just hits a brick wall. The downturn can be shockingly fast and way more severe than you'd expect. So, what are we missing here? What's the secret ingredient? And this is where we get to the core insight of the research. It turns out the answer isn't in looking at the economy as just one big thing. Nope. We have to see it as a tale of two very, very different kinds of companies. On one side, you've got your small firms. Think about your local manufacturers, the kind of businesses that are the real backbone of an economy. For them, cash usually comes from one place, a traditional bank loan. But on the other side, you've got the giants, the big, publicly traded corporations. They have a whole menu of ways to get cash. If a bank says no, they can just issue their own bonds or something called commercial paper directly to investors. Their access to money is just in a different league. This huge difference really boils down to this one key idea: capital market access. All that means is, how easily can you get your hands on cash when you need it? How many doors are open to you? For a small firm, maybe there's only one door, the local bank. For a huge firm, there are dozens of them. And here's the perfect way to picture it. A large firm is like a supertanker. When a storm rolls in, say an interest rate hike, it's got the size and the power to just plow right through it. But a small firm, it's like a little fishing boat. And that exact same storm can be an absolute catastrophe, tossing it around and threatening to sink it completely. So, how does this difference between the supertanker and the fishing boat actually make the Fed's actions so much more powerful? Well, this is where we see this hidden mechanism kick in, something we can call the credit squeeze. It works like a chain reaction. First, the Fed raises rates. That makes money more expensive for banks, so they get nervous and start tightening up their lending. And who are their main customers? Small firms. So they're the first to feel that squeeze. With their main source of cash suddenly drying up, these small businesses have no other choice but to slam on the emergency brakes. They have to cut inventory, cancel new orders, stop hiring, everything. And it's that sudden, panicked reaction from thousands and thousands of these small firms all at once that turns the Fed's little tap on the brakes into a massive economic shockwave. Now, that is a really powerful theory, right? But Gertler and Gilchrist didn't just leave it as a theory. They dug into the data. And what they found was, well, a stunning confirmation of the whole story. As soon as the Fed tightens policy, you can see the fortunes of these two types of firms just split wide open. The sales of big firms might dip a little bit, sure, but for small firms, their sales don't just dip. They absolutely fall off a cliff. But this right here is maybe the most amazing piece of evidence. Look at how they handle their inventory. 2 years after a rate hike, the big firms have actually increased their inventory by about 5%. They're using their financial muscle to stock up while things are slow, getting ready for the next boom. But small firms? They've been forced to slash their inventories by almost 11%. They're not planning for the future, they are just trying to survive today. So you've got these two completely opposite strategies playing out at the exact same time. The supertanker is actually borrowing more to smooth out the ride. Meanwhile, the fishing boat is desperately throwing cargo overboard, selling off inventory just to stay afloat because it has absolutely no other choice. And here's the kicker. Small firms only make up about 30% of total manufacturing sales, but when the Fed hits the brakes, they account for nearly 60% of the total drop in sales. Just think about that for a second. This minority of the market is responsible for the vast majority of the downturn. It is a wildly disproportionate impact. This disproportionate impact is the key to the whole puzzle. It's what we can call the Main Street amplifier. So let's bring it all home. Why does this matter so much for how we understand the economy? The big takeaway here is that small businesses aren't just sad victims of a recession. Their fragile financial position means they actively amplify it. The health of Main Street isn't some side story. It's a critical channel. It's like the hidden wiring that connects a decision in Washington, D.C. to the economic reality in every single town. And that explains why a seemingly small rate hike can feel like a massive earthquake on the ground. And so that leaves us with one last really important question to think about. If we know that these small businesses, these little fishing boats, can amplify a small storm into a hurricane, how should we all, from policymakers to investors, be thinking about their stability the next time we see an economic storm brewing on the horizon? Because it just might be that the fate of the giant supertankers really depends on the resilience of the smallest boats in the fleet.